In this week's market update, politics grabs the headlines, but the trade war dominates market sentiment. Oil is in focus as Saudi Arabia warns of a price spike, Japan hikes VAT again, and China celebrates 70 years of party rule. The Tory party conference and the growing threat of impeachment for President Trump means that politics will continue to grab the headlines on both sides of the Atlantic this week. But for investors, the key driver of markets remains the trade war in the wake of last week's apparent escalation of tensions between the US and China. The threat to ban Chinese companies from listing on US markets represents yet another raising of the stakes in the ongoing trade spat, even if the White House is busily backpedaling again this week. It broadens even further the scope of the battle between Washington and Beijing and confirms that this is about much more than tariffs and trade. This is a fight for global dominance in the 21st century. The impact of rising tensions is also becoming a bit clearer this week. An indicator of the knock-on effect of the measures so far came yesterday with manufacturing data showing activity in China falling for a fifth consecutive month, even if the numbers were a fraction better than feared. Yesterday also we got a glimpse of Germany's exposure via unemployment, which rose slightly on an unadjusted basis in August. Later this week we'll get a snapshot of the US jobs market, with Friday's non-farm payrolls data expected to show a continuation of last month's disappointing employment data. The key question for investors is how the slowing economy feeds through into the numbers. US growth is penciled in at under 2% next year, with a mid-year trough of as little as 1.3%. That is forecast to lead in due course to unemployment of 4.3%, about half a percentage point higher than today's 50-year low level. The risk is that the global economy is now at a point where an unexpected shock could tip it over into recession, justifying the negative messages still being sent out by the bond market, where the yield curve is flat, as it has been before all recent recessions. We got a sight of what that external shock might be this weekend as Saudi Crown Prince Mohammed bin Salman warned that the oil price could skyrocket to what he called unimaginably high numbers due to the ongoing tensions with Iran. He called on the world, meaning the US, to take strong and firm action to deter Iran to prevent a damaging spike in the oil price. Tensions between the two countries flared in September after drone and missile attacks hit Saudi oil production facilities, triggering a temporary spike in the cost of crude. Iran has denied involvement in the attacks, but Washington, Riyadh and European capitals have all pointed the finger at Tehran. The oil price reaction has so far been relatively subdued, reflecting the underlying oversupply of the global oil market thanks to the abundance of shale production in North America. But no one imagines that military action would not have a dramatic impact on the global oil price. That in turn would have an adverse impact on inflation. It's not an issue currently, but one that investors are starting to become more concerned about as wage growth accelerates. Geopolitical tensions in the Middle East are just one concern for investors in a week when China's celebration of 70 years of Communist Party rule has raised fears of further unrest in Hong Kong, where weeks of protests intensified at the weekend. Here, too, the impact of rising tensions is being felt on the economic front, with occupancy in the former British colonies' hotels tumbling as visits from the mainland collapse. Staying in Asia, Japan will likely be in focus this week too, thanks to the imposition of a further hike in the country's consumption tax from 8% to 10%. 5 years ago, a previous hike from 5 to 8% created a significant economic and stock market wobble as an already struggling economy was squeezed further. The health of the Japanese economy is better today than it was then, as retail sales data this week confirmed, but investors are nervous about how well consumers will handle the latest tax hike. Twice since 2014, the Japanese have postponed the latest planned increase over fears that the economy was just too fragile to take the hit. The share prices of retailers in Japan have underperformed the wider market all year in anticipation of the tax rise. Now, closer to home, the arrival of October brings us less than a month away from Brexit Day. After a week of chaotic headlines, including the UK's Supreme Court ruling that Prime Minister Boris Johnson had broken the law by proroguing Parliament, attention is now focused on the ruling Tory party's annual conference. There's little hope that attention will drift far from Brexit, however, as the threat of a no-confidence vote rises and the PM continues to dig his heels in, promising the UK will leave the EU at the end of the month, come what may. The chance of him securing a deal with the EU looks more remote as the deadline of 19th of October approaches, although we have been promised further details of the government's last-ditch plan this week. Failure to get a deal by that date means, in theory, that the government will be required to ask for a further extension to the Article 50 process in order to hold a general election and break the impasse. However, the government continues to explore alternatives, including the possibility that another EU state might be persuaded to block a further Brexit delay. Across the Atlantic, politics has taken a dramatic turn too, with the Democrat opposition finally deciding it has the grounds to impeach President Trump after it emerged that he'd put pressure on the Ukrainian government to probe the business affairs of presidential rival Joe Biden and his son, Hunter. This week, the pressure on the president intensified further after it emerged that he'd also sought help from the Australian Prime Minister, Scott Morrison, to discredit Robert Mueller's investigation into Russian interference in the 2016 US election. If it can be proved that the president used the withdrawal of financial aid as a lever in those discussions with Ukraine, a case for abuse of office could be made. If he's impeached, Trump will join a very short list of previous presidents to be called to account in this way. Just two have been impeached before, Andrew Johnson in the 19th century and Bill Clinton more recently, although neither were removed from office. Richard Nixon avoided impeachment by resigning first. The challenge for those seeking to impeach the president is the fact that it's relatively easy to impeach, with only a majority in the House of Representatives required, but it's difficult to convict a president for which a two-thirds majority in the Senate is needed. Whether or not Mr. Trump can survive this latest attack will depend on how much the Republican Party considers him to be an asset or a liability in the run-up to next year's election. Now, one man who's definitely handing over the reins of power in the weeks ahead is Mario Draghi, the head of the European Central Bank. He will shortly be leaving office after 8 years in which he has adopted a consistently dovish approach to European monetary policy. During his tenure, interest rates have never been raised, despite increasing calls from central bankers in Germany and Holland for him to adopt a tougher line. As Draghi prepares to leave the ECB, he's becoming increasingly vocal about the need for governments to step up to the plate alongside central banks. He believes that governments, notably Germany's, should take action to stimulate the economy now that monetary policy has run out of road as interest rates have fallen into negative territory. Draghi leaves the ECB on the 31st of October, with former IMF head Christine Lagarde taking over the following day.